Peter Barnes is with New York Federal Reserve Bank President William Dudley in an exclusive. Peter, good morning.
Hey, good morning, Sandra. That's right, and that is the big question for investors: is what will the Fed be doing in the coming months on interest rates, if anything? Bill Dudley, thanks for joining Fox Business yet again. Back in July, you gave a speech on the state of the economy, and at that time you said that you felt that the economic indicators suggested that the Fed proceed cautiously in additional rate increases, which could start as early as the next meeting in September. But since then, we've had another very strong jobs report. What do you think now?
Well, I don't think my views have changed very much. I mean, I think we're looking for growth in the second half of the year that will be stronger than the first half, so some acceleration in the growth outlook. The labor market continues to generate reasonable job gains. We've 190,000 in the last 3 months. So I think, we're edging closer towards, the point in time where it will be appropriate, I think, to raise interest rates further. As I said in the speech that I gave last month, there are reasons to think that monetary policy isn't particularly stimulative right now, and you can sort of judge that by the fact that we only grew at a 1% annual rate in the first half of the year. So we probably don't have a lot of monetary policy tightenings to actually do over time. But the labor market is getting tighter. We're starting to see signs of wage gains starting to accelerate. And so I think we're getting closer to that point in time where it will be appropriate to actually raise short-term rates again.
And the other part of your mandate is to get inflation up to a reasonable level. You have a 2% target. And where does the inflation read stand as far as you're concerned? Are you getting closer to target?
Well, we're getting closer in the sense that headline inflation is drifting up a little bit because the earlier declines from energy prices are dropping out of the year-over-year calculations. But core inflation, which takes out energy and food because it's a more reliable indicator of the underlying trend of inflation, has been pretty flat over recent months. So in my mind, the inflation outlook really hasn't changed very much. The key question is, are we going to get enough growth, put pressure on resources, pushing up wages, and gradually pushing up inflation towards 2%? So far, we seem to be on that trajectory, and we'll have to see how it plays out in coming months.
Could you see a rate hike potentially in September? You also have meetings in November and December.
Yeah, I think it's possible. I mean, I think we'll have to see how the data falls and where we are in terms of the broad supports for the economy. I think the economy is in okay shape. I mean, I think that consumption is doing quite well. Real income gains are pretty sturdy. Job gains are pretty sturdy. Against that, you have some weakness in business fixed investment. Perhaps the election uncertainty may exacerbate that weakness in business fixed investment for a little while. But in general, the economy, I think, is going to be better in the second half than it was in the first half. I think the labor market's going to continue to tighten. And in that environment, I think we're getting closer to the day where we're going to have to snug up interest rates a little bit. And that's good news. I mean, if we get to the point where we want to raise interest rates again this year, I think that would be good news, because it would be basically saying that the Federal Reserve, we think that we're getting closer to our objectives of maximum sustainable employment in the context of price stability.
Now, as you know, measures of market expectations for rate hikes suggest that markets don't think the Fed is going to raise rates anytime before 2017. You warned in your speech last month that investors might be getting too complacent about the possibility of rate hikes in 2016. Does that still stand?
Oh, absolutely. I mean, you look at the futures markets for the federal funds rate, which is the rate that we target. It has basically one rate hike priced in through the end of 2017. I find that too low. I think the market is complacent about the need for gradually snugging up short-term interest rates over the next year or so.
But let's talk about the markets. We've seen record highs in the major indexes. The bond markets are still very strong, still very low interest rates. Are you concerned at all about any bubbles forming in asset markets?
Well, it's something we look at all the time, because obviously if you have a financial asset bubble, the collapse of that bubble can lead to a lot of stress on the financial system and potential have bad effects on the macroeconomy. But I don't see anything now that's particularly disturbing. I would argue that the one area which looks a little bit stretched to me is the bond market. And some of that's due to what's happening in the rest of the world. So we have quantitative easing programs in place in Japan, in Europe, in the United Kingdom. And that demand for long-term assets, I think, is actually creating a search for yield globally, and some of that's spilling over into the U.S. So, for example, the 10-year Treasury yield, 1.5%, is pretty low in an environment where we think we're making progress towards our objectives. We're pretty close to full employment. We think inflation is going to trend back to 2% over the next couple of years. 1.5% 10-year Treasury yield seems pretty low in that environment.